What is depreciation? Is it actual money you're losing?
You might not be taking depreciation the right way. You might not be making the right elections on your tax returns. For your real estate, we see that happen all the time. The short-term rental loophole, it's been called, where if you basically rent a property for 7 days or less, you don't need to qualify as a real estate professional. You just need to materially participate in the rental property, which can be done by spending, as simple as spending more than 100 hours and making sure no one else spends more time than you.
Thanks for joining us for another episode of The Accidental Landlord. Today we have Thomas Castelli, and he is a CPA and a tax strategist. And taxes is not like the most exciting thing about real estate, but it does become exciting when you start to see how much money you can save in taxes. So real estate, I feel like it's a gold mine of paying less taxes because there's different strategies and there's depreciation. There's all these things that allow you to pay the government less, which I think most people are generally a fan of. So take a listen. There's like a short-term rental loophole that we talked about that I think is really beneficial that a lot of people can take advantage of. Difference between passive and active income, why people like Warren Buffett pay less in taxes. We've answered some of those questions as well. So take a listen. Hope you get some value out of it. Thanks for coming back for another episode, and let's get right into the show. Thomas, welcome to the show.
Thank you for having me on here today. It's an honor to be here.
Yeah, it's the feeling's mutual. Why don't you take a minute or two to explain to our listeners who you are and maybe a little bit about your podcast, and then we can get right into it.
Yeah, absolutely. So my name is Thomas Castelli. I'm a CPA and tax strategist, as Peter mentioned. I work exclusively with real estate investors across the United States. I work with clients who have as little as one rental property, and our firm works with clients as large as syndicates and funds who have hundreds or if not thousands of properties. So we kind of get a good mix of it all. So I've seen just about everything at this point. What we go through on our podcast called the Tax Smart REI podcast is we really break down and kind of outline the various tax strategies and tips and tools that landlords and other real estate investors can use to minimize and reduce their taxes as they kind of go along their journey of real property ownership. And we also sometimes bring on experts, share their stories, how they built their portfolios, things like that. So that's kind of just a little bit about the podcast.
Yeah, awesome. I think it's going to be a super relevant conversation because our podcast is called Accidental Landlord. They're generally, newer real estate investors or real estate investors who kind of stumbled into their investment, i.e. they inherited something or they're moving away and they don't want to sell their house, right, and now they're a landlord. But there's a lot of, I don't want to say mystery, but when it comes to what you can and can't do tax-wise. So there's a couple things that I definitely want to talk about. But before we get too far, everyone hears stories of, Warren Buffett pays less taxes than his secretary, or Donald Trump paid zero taxes, but he made, millions or billions of dollars. Like that sometimes doesn't sit well with people. And I think it's just lack of understanding what it is. And so can you just briefly, I'm sure they have really complicated tax strategies, and that's not the point of the question, but what are those guys doing to pay less in taxes? And are those things available to your everyday, people like you and me just trying to make a living?
Yeah, so there's a lot to break down there. So I'll give a few things, right? So what like someone like Warren Buffett does. Warren Buffett owns a majority of Warren Buffett's wealth comes from his holdings in Berkshire Hathaway, which is a publicly traded stock. What gentlemen like him could do is, first of all, most of us, including myself included, pay tax at ordinary income tax rates, right? We receive a salary, or maybe we have a business and that business throws off income, and we're going to be taxed at rates up to 37%. Whereas Warren Buffett has most of his wealth, again, in that stock holding. So that stock holding is going to appreciate in value over time. So if he were to sell the stocks, he's going to pay tax at the preferential tax rates, the capital gains tax rates, 23.8% when you include net, right? So we're paying up to 37%. Someone like a Warren Buffett's paying 23.8%. Now, what gets even more interesting in an asset like that is you can actually pledge your stock, basically put up as collateral and get a loan. Right. So say Warren Buffett, I don't know what he's doing, but to say he wants to buy a new car, right? Instead of selling the stock to buy the new car, he can go pledge his Berkshire Hathaway stock, get a loan using his stock as collateral. The loan proceeds are tax-free, right? So he doesn't pay tax on that loan proceeds. Now he goes and buys the car and pays off the loan that he used his stock as collateral. That's a little strategy. People call it buy, borrow, die. Basically, it's like you have an asset, the asset appreciates in value. Rather than selling that asset and realizing a capital gain, you just borrow against that asset to buy. So that's how Elon Musk bought Twitter. He took a loan out against his Tesla stock and used it to acquire Twitter. So that's how that's one way they do it, right? That's one kind of way they use this buy, borrow, die strategy. Other way to do it, people like perhaps Donald Trump, right? There's something called the real estate professional status. The real estate professional, okay, so all losses from rental properties are passive by default underneath the tax code. What does that mean? That means that if you have a loss from your rental property, it's not going to be able to offset your W-2 or your active trade or business income and help you reduce taxes. It can only offset other passive activities. However, the real estate professional status allows your rental losses to become non-passive and be able to offset your W-2 income or your income from your active trade or business. So, for example, let's just say your rental property threw off a loss of $10,000. Well, if you had the real estate professional status, that $10,000 is now offsetting your W-2 or your active trade or business income. Now, to qualify, you need to work more than 750 hours and more than half your total working time in a real property, trade, or business. So effectively, you have to be working full-time in real estate. So while I don't know the particulars of Trump's situation off the top of my head, I would venture to guess at some point over his career, he was using the real estate professional status, taking the losses from all of his vast real estate empire and using it to offset the income that he was earning from other sources. So those are kind of two different ways that I guess you could say the rich pay less taxes. Having said that, real estate professional status is available to anybody who could spend more than 750 hours and more than half their total working time in a real property, trade, or business. Anybody could use that. Buy, borrow, die, almost anybody could use that as well, especially if you own real estate. Whether it be your primary residence, you might already be familiar with it, HELOC. When you take a HELOC out against your residence, you're effectively using this strategy. Now, if you have a rental portfolio, could be one property, could be many properties. As that portfolio appreciates, you're going to have equity in that property. Your equity is going to rise, right? And you could borrow against that equity. So really, anybody could use that strategy, either of these strategies, if you're aware of it and you just set yourself up for success.
Yeah, I think it's important to note that, like you said, any real estate investor can do similar things. Sometimes it's tricky on who can qualify for the real estate professional status, but you bring up rental property losses, and if for a novice investor, they may think that they're actually losing money every single year. And obviously, one of the big benefits to real estate is the depreciation that you can take. And so sometimes people get confused about what that is. So speak to, what is depreciation? Is it actual money you're losing? How does that, when we talk about losses, how does that all add up?
Right, that's a great question. So basically, when you buy a property, it's probably going to be relatively expensive, right? Like, say you buy a property, let's just call it $300,000 to keep it easy, right? Well, if you buy a $300,000 property, you're not deducting the cost of that property all in the first year on your tax return. And that's because it's going to last for longer than a year. So it's going to be depreciated. So that means like each year you're going to have an expense, and this expense is going to help you recover the cost of this asset. Now, the depreciation expense only exists on paper. It does not actually exist. So if you had a profit and loss statement, if you just imagine a profit and loss statement for a second, you're going to have revenue at the top. It's going to be rental income. Then you're going to have expenses. Some of these expenses are going to be what I call like hard expenses. These are expenses that you actually pay somebody. It leaves your pocket, leaves your bank account, right? Property taxes, utilities, maybe property management fees, repairs, maintenance, insurance, all these different expenses. And then you're going to have this one expense called depreciation, right? Depreciation is non-cash, so it exists only on paper. So here's a quick example. Let's just say you had a rental property. It's grossing $10,000 in rental income. And let's just say that you have, for the sake of this example, let's say you have $4,000, right, of $4,000 of hard expenses. These are expenses that left your pocket. But now let's just say you have a $6,000 depreciation expense. Well, which is realistic, very realistic. This depreciation, so now let's just recap this. So $10,000 rental income, $4,000 of hard expenses. Well, now you basically have rental income. In most businesses, you have net income of $6,000. You end up paying taxes on that $6,000. But now we enter this depreciation expense, which is non-cash, only exists on paper. $6,000. You now have it's netting out to zero. So you didn't pay any tax on that rental income. Now, in many cases, that depreciation expense could be much greater than the $6,000 I just mentioned, and cause a loss. So the loss is it only exists on paper because the depreciation expense is reducing your taxable income, but not reducing the cash flow you're generating from the property. And the use of depreciation is what makes real estate one of the most tax advantage asset classes in existence. So, and anybody who
go ahead, finish up. Yeah.
I was going to say anybody who owns rental property can take advantage of that.
Yeah. So let's just say we have a rental property and real estate's expensive in our area. You know, your average house is $800,000, $900,000 here, just like a 3-bedroom, 2-bath ranch house or something. They have these depreciation expenses. They show a big loss on paper, but do they get to take that? Well, there's two things. One is the real estate professional status, like that. I think if you qualify for that, then you're taking that loss against your ordinary income. But let's assume they don't have that. And then let's also assume that they're a high income earner, like say they make, $200,000 a year. Are they able, how does that loss on paper affect them? Because I know there's rules surrounding that.
Right. So let's kind of break it down 1, 2, 3, right? So again, like you said, if you're a real estate professional, right, great, that loss offset your other income, you're good to go, right? But if you can't qualify as a real estate professional, there's something called the special loss allowance. The special loss allowance allows you to take up to $25,000 of rental losses against your other forms of income, your W-2 income or income from a business or what have you. If your modified adjusted gross income, also known as MAGI, you might see it, is under $100,000. So if it's under $100,000, you could take up to $25K. Now, this deduction, the special loss allowance, phases out $1 for every $2 of income you have above $100,000 until it's phased out completely at $150,000, and you can't use it once your income's above your MAGI is above 150. So, kind of give an example. Let's say you had $125,000 in modified adjusted gross income. Well, you can only take 12 and a half. You can only take half the deduction now, 12.5K. But if you had say you had $90,000 in MAGI, well, now you could take up to 25K. And if you had $151,000 in modified adjusted gross income, you can't use this at all. So that's how it works when your income's below 150.
Okay, so do you lose that deduction, or can you take it some other time?
No, it's once your income's above 150. What's going to happen is your passive losses, they're going to be suspended and carried forward on your tax return. So what happens is, like, let's just say that your modified adjusted gross income was $151,000. You're above the threshold, and you have $10,000 of rental losses that year. That's going to be suspended and carried forward to next year. And on next year's tax return, if you have rental income or passive income from other activities, like maybe you're a passive investor in a pizzeria or something like that throws off income, those losses can offset that income next year, or the gains on the sale of a rental property or another passive activity. So, and if there is no income that next year, or if you have more losses that next year, those losses will just continually be carried forward until at some point where you do have rental income or passive income, or you do ultimately sell something. One of those types.
Gotcha. So if you sell that piece of property that's producing those losses, then you can take the loss against whatever the proceeds from the sale were.
Right. So so if you sell it, you have a capital gain. Those losses or the losses from that property or other rental properties you have can offset that capital gain. Likewise, say you have a property that is producing net rental income even after depreciation. It's uncommon, especially in today's environment, but it does happen. And in that case, those losses could also offset that income as well.
In your experience with your clients that you work with, is it difficult to get someone real estate professional status, or is it relatively simple, or what does that look like?
Well, it depends, but it's generally going to be challenging, right? And the reason for this is that it has to be more than 750 hours and more than half your total working time. So if you have a W-2 job or you have a business that's not a real estate business and you're doing that full time, then it's going to be virtually impossible to qualify for the real estate professional status. It's the most litigated area of the tax code, over 500 tax court cases and counting on it. And there's many of taxpayers have tried to qualify for the real estate professional status while having a full-time job, and all but one was able to actually qualify, right? So out of all these tax court cases, only one person was able to qualify, and that's because they were able to prove they were a pilot. They were able to prove that they only worked 1,000 hours in their full-time job as a pilot, and they were able to overcome this presumption. But the bottom line is, if you have a full-time W-2 job or you have a business, not a real estate business, you're not going to qualify, right? It's just how it kind of crumbles.
So not a good idea if you're trying to just manipulate the numbers and figure out how you could get categorized as that. Probably not the best thing to do.
I would not suggest that, but there is one strategy I could share that does work for couples, right? So if you're married and you file a joint return, married, file a joint, and one spouse can qualify as a real estate professional, then the losses from your rental properties can offset the other spouse's W-2 income or income from a trade or business. So a lot of times we'll see like a high income earner, spouse A will have a high income, spouse B will maybe work part-time or not work at all. They might take over the management of their rental properties, or maybe they're a real estate agent and they work full-time in real estate anyway. And in that case, if one spouse can qualify as a real estate professional, then both spouses get the benefit as long as they're filing a joint return. So that's probably the most common way we see people qualify who are not like already full-time in real estate.
Gotcha. If your W-2 income comes from real estate, like we have a property management company, and if we have an employee who arguably works in the real estate business, but their income 100% is W-2, would they qualify as a real estate professional?
Unfortunately not, and because there's a stipulation within the tax code. In order for your hours to qualify, you need to own at least 5%, right? So if the employee were to own 5% of the property management company, for example, then yes. If they don't, then the W-2 hours they spend in that business, although it is a real property trader business, basically counts as if it wasn't. It's just kind of what's in the code.
Gotcha. So this is good information, because we come up against this not all the time, but it happens. Hey, how can I, our clients who we manage property for us, I need to document that I'm participating in this activity. And it's like, that's going to be really hard to do from our perspective, but I see a lot of people trying to fudge the numbers so they can qualify for this. Go ahead.
I was going to say, when you're working with a property manager and someone's managing your property, the IRS considers you by default not to be involved in the day-to-day management of your properties, and that could significantly hurt you. So if you're qualifying for the real estate professional status, you virtually have to, if you only have a handful of properties, you have to either self-manage, or you have to have such a vast portfolio where that you need property managers to maintain your portfolio overall. So that's just something to keep in mind for anybody who might be listening to that.
Yeah. I try to discourage it. I'm like, this doesn't seem like a good idea for you, but we obviously refer them to their CPA or whatever. What about people who buy assets strictly for the depreciation and the offset of income? I think that's a thing. Can you speak to it? I think some people hear that and think it's insane. Like, why would you do that? But what's involved in that strategy?
Yeah, so we have a saying at our firm called "Don't let the tax tail wag the dog." Might have heard of it before, but basically, is whenever you're looking at an investment decision, whether it be real estate or another asset, because there's plenty of other assets out there that could generate depreciation, like fitness centers, ATMs, things like that. Is you got to look at the investment merits of that particular investment, like. Does this fit your long-term investment strategy? Is it a good investment? Like, should you even be putting money in this investment anyway? We see many people chase bad investments trying to get tax benefits. So the first question is, does this make investment sense? If the answer to that question is yes, then we go on to the next stage. What's the tax ramifications? Now, some people will buy assets just to offset their other income. So there's a few buckets, right? People who are high income earners, they're paying 37%. They'll try to use the real estate professional status If they can qualify or their spouse can qualify and you're purchasing investment properties that make sense, by all means, go for it, right? And you could legitimately do that. Other times people might have passive income or be selling a property at a gain. So for example, you might have a highly appreciated property that you own for a few years. Now you're getting ready to sell it. Well, one strategy is to invest in another property in the same year that you're selling said property, and then you can use like a cost segregation study, and we could talk about that if you want to go deeper into that cost segregation study and bonus depreciation to increase the losses on that new property and use those losses to offset the gain on the sale of the other property. So that's another strategy. It's called like the lazy 1031 exchange. It's kind of been coined, but that's another option. The other one is it's actually there's another strategy called the short-term rental loophole. It's been called, where if you basically rent a property for 7 days or less, you don't need to qualify as a real estate professional. You just need to materially participate in the rental property, which can be done by spending as simple as spending more than 100 hours and making sure no one else spends more time than you. Then you could take the losses from that short-term rental against your active income. So as a whole, I would say it's definitely a strategy people use. Those are kind of three ways people use it. If the properties make investment sense for your investment strategy as well as just plain old investment sense, then go for it. But if not, don't try to throw good money after bad, if you will, by trying to invest in a bad investment just to get the tax benefits. That's my 2 cents.
Gotcha. No, I appreciate that. Makes sense. I was going to bring up the short-term rental loophole, and you kind of already did. So do you see that coming under scrutiny by the legislative bodies trying to get rid of that, or do you think that's going to stick around for a while? Because I think a lot of people are using it.
Yeah, that's a great question. So I'll kind of give the quick breakdown on that, right? So the laws. So the short-term rental loophole is is part of the regulations where they have exceptions to the definition of rental activity. So all rental activity is passive by default, unless you can qualify as a real estate professional. But under this section of the code, there's exceptions to the definition of rental activity, right? That basically makes the rental activity a business activity. And that's if the property has an average stay of 7 days or less, if the property has an average stay of 30 days or less, but you provide substantial like hotel-like services to your guests. Now, these rules have been around for decades, and they were primarily put into place for hotels, right? To make hotels, motels, things like that, not passive by default, but an actual business, because that's in many cases what they are. So we've not seen any legislation at all, proposed or otherwise, hinting that would be changed or altered. The reason why people call it a loophole, by the way, some people start to ask at this point, okay, well, if it's in the tax code, why is it a loophole? Because when these laws were written, I think in the 80s, if I'm not mistaken, they probably didn't see Airbnb, VRBO making short-term rentals as widespread, as easy to get into as they are today. So that's why it's kind of called a loophole. So yeah, no legislation looking to attack that. What I will say, though, is there's a lot of legislation going on at the local level, right? For example, on June 15th, Dallas banned short-term rentals in neighborhoods that are zoned for single-family homes, basically. So there's plenty of other cities and local governments that have been doing these. I know California has significant restrictions on short-term rental properties. So I don't see it being regulated at the federal level through the tax code. I see short-term rentals being regulated at the local level through local governments. So no, the short-term rental loophole is not going anywhere, but the short-term rental markets are shrinking to an extent.
Yeah, absolutely. Yeah, in our area, it's a minefield of regulation when it comes to whether or not you can short-term rental. But so, quick follow-up question on the short-term loophole: if you can qualify as a short-term operator using that loophole, can you then lump in all of your passive losses from more traditional rental properties and use those losses?
Yeah, that's a great question, and we get that a lot. Unfortunately, not. That would only apply to the properties that meet that exception. So, if you have, say, 3 short-term rentals that meet that exception, say 7 days or less, and then you have 20 long-term rentals, well, those 20 long-term rentals, assuming you're not a real estate professional, would be passive, right? Unless you could use special loss allowance.
Gotcha.
The other short-term
rentals. It's not like it opens the floodgate and then you just take all the losses no matter what.
Right.
Okay. That's good information. I've heard so much like misinformation on that short-term rental loophole. It's good. You had a pretty succinct, good way to describe it because it can be confusing sometimes to people. Um, let's talk about owning a business versus owning real estate from a
Right.
tax benefit standpoint. So there's plenty of people I've had conversations with people who try to argue that it's better to own a business for tax purposes than it is to invest in real estate. And obviously they each have their pros and cons, but, and I know you focus on real estate, but do you have any expertise on the tax benefits of being a business owner versus real estate or?
Oh, for sure, for sure. So I think it depends on the business, right? I think it definitely depends on the business. Certain businesses have more tax benefits than others. For example, if you own a fitness center, I'm just going with this because it's a heavy on fixed assets. You know, when you own a fitness center, you're going to have all these machines and equipment. Those machines and equipment, assuming you own them and not lease them, don't lease them, they're going to be able. They have a depreciable life, typically of 5 years. So that means they're going to be depreciated over 5 years. So you're going to get a big depreciation expense. And they're also going to be eligible for something known as bonus depreciation, which allows you to basically in 2023 deduct up to 80% of its cost in the first year. So that business could be extremely lucrative from a tax perspective. You might have other businesses that have no fixed assets, right? Like consulting or a CPA firm, for example. All of these have virtually no fixed assets. So you don't have much deductions out. You have virtually no non-cash deductions, right? All the deductions you get are actually expenses that are actually reducing your actual cash flow as well as your taxable income. So it's very hard to say. What I would say is this. I tend to look at it differently, a little bit differently. You need to have some way to earn income, right? Because if you have a way to earn income, then you can put it into best way to look at this, in my opinion, businesses are a great place to generate income. Great source to generate income. Real estate's a great place to store wealth, right? So if you have a business, for the most part, you're going to have maybe higher taxes on that source of income, but you take that income and you pour it into real estate. Now real estate has all these tax benefits that allow you to shelter the rental income that's being generated from the real estate from tax, as well as all these ways to mitigate capital gains when you ultimately sell the property. So I would say that there's no either or which one's better from a tax perspective. Most of the time in most businesses, although you're going to be able to deduct a lot of expenses, you're also going to be paying a lot of money in taxes on the net income you're generating because there's not, in many businesses, not this big depreciation expense you're able to shelter your income with. So I don't know if that makes sense. That's kind of the way I look at it.
Yeah, no, it does. It totally does. Yeah, good answer. What are your so there's statistics out there that I think it's like 60-70% of rental properties are managed by the people who own them, meaning they don't use professional property managers. They are very like DIY type of a mindset. And then some of these people also will go file their own taxes with like TurboTax or these types of things. What advice do you have for that person? Like, what are the most common things that they're missing? Like, obviously, I think we both would agree, like, you probably should use a professional tax advisor and use someone who knows what they're doing to manage the property and all those things. What are you seeing from your area of expertise that these types of people are missing or not taking advantage of from a tax perspective?
Okay, that's a great question. Yeah, so there's a lot in there I could say, but I'll just keep it simple on the tax side. So basically, when you're doing your own taxes, you don't know what you don't know, right? If you have a W-2 job and you have a few investment accounts, a few brokerage accounts, you could easily do your taxes on TurboTax, no problem. It's pretty easy. But once you start getting into more sophisticated investments, more hands-on investments like business or real estate, you might be missing expenses that first of all, you need good record keeping. So you need a bookkeeping system. That's kind of the first thing, right? But a lot of people miss that. They just have all their expenses in a shoebox. Then come the end of the year, they're missing deductions that they're allowed to take because they don't have good records. So first things first, if you're in that situation, you want to have a bookkeeping system, right, to maximize your deductions. Secondly, you might not be taking depreciation the right way. You might not be making the right elections on your tax returns for your real estate. We see that happen all the time. people who erroneously elect the real estate professional status on their tax return because it's so easy to do. You just check a box. That's really easy to do when you're filing your taxes, but are you actually a real estate professional? We see people get that wrong all the time. People who are legitimately real estate professionals not taking it because they're not aware of it. There's just little things like that, missing deductions they're entitled to, or erroneously filing things that they shouldn't be filing. That's kind of the biggest thing. Having said that, you're kind of on a more philosophical level. I am one of these big believers that as you scale up any business, you do want to get out of the stuff. You want to focus on your area of expertise and delegate or outsource the rest, right? So property management, right? That's a big one. Unless you like to be a property manager, then if you want to really scale your portfolio, you're going to need someone else to take that over at some point. So hire a property management company. Same thing with taxes. I think tax is even easier to say this, and not just because I'm an accountant, but just literally just delegate find a good CPA and hire them to do your taxes for you. It's just not the highest and best use of your time. You're probably missing things. You might be doing things wrong. You're putting yourself at risk, and you're just wasting your time. It's time at some point. Yeah. Once you scale it to a certain point, and you're not pinching pennies, right? It's time to start delegating some of these things out.
Yeah, I would say that to steal from a real estate term, but the highest and best use of your time is not these things that you could easily outsource people to. I mean, if you outsource a property management company, is like pennies on the dollar compared to how much time it takes. Or, I mean, to me, it's not even the time that they're giving up. It's the money that they're missing is the bigger problem, like electing the wrong thing or not taking depreciation or not, using these things that you're supposed to. What does the IRS do if you miss a deduction? Do they knock on your door and say, hey, you should have added this in here. Let me give you some money back? Or
most of the time they're not. Okay. They're not, they're coming after their money when you're wrong. If you don't take the deductions you're allotted to, they're going to look the other way. They're not going to do you any favors. However, I will say this. Depreciation is another expense we see people just not take, especially when they self-file. And here's the problem with depreciation. The IRS is not going to slap your hand when you're not taking it. However, when you sell that property, something called depreciation recapture. Basically, you pay tax on the depreciation you took over the life of the property. There's ways to mitigate it, and there's ways to defer it, and that's all well and good. But if you didn't take it, the IRS assumes you took it. Right, when you sell the property. So you have to pay the depreciation recapture tax, even if you didn't take depreciation, right? The IRS is not going to knock on your door when you don't take the deduction. They are going to collect later on. So,
yeah. I always find that a funny one. Like, I'm not going to take it. Well, you're taking it one way or the other. You're going to pay tax on it. You might not be getting the benefit of it, but you're going to pay the tax on it later. Question for you. So I struggle with this conversation with our clients sometimes. They'll say, I have a CPA. And I go, okay, great. Like, do they understand real estate? Well, I don't know. They've been doing my taxes for 25 years. I think they do. They must. Mm-hmm. And I see that get people into trouble sometimes. So speak to, that. And then also the other thing that I wanted to talk about is the difference between a CPA who just does taxes at the end of the year and someone who plans a tax strategy for you that you deploy forever, always, right? And is constantly looking at it and figuring out ways for you to maximize your tax benefits. Go ahead, run with that if you don't mind.
Yeah, no problem. So most CPAs out there, they are generalists, right? So they dabble in a lot of different industries. They have clients maybe in manufacturing, maybe they have clients in professional services, maybe consulting, and then they have some clients in real estate. Because of that, they stay like very surface level on all these things. So they know enough to be dangerous about all these things, but they never really dive deep into any one specific area, deep enough to know the nuances and everything that's available, the tax court cases, the weird little regulations. Like, tax is a lot more complicated than even when I got into the tax field. I was already a CPA, and I'm like, whoa. I'm like, it's a lot more complicated than it probably needs to be, but it is what it is. And I think people, when you're working with a generalist who's doesn't have a deep expertise in real estate, you're probably missing something. You're probably missing deductions. You're probably missing out on different strategies you can do and things you can do to actually minimize taxes. You might even be doing things wrong. And we see this happen all the time. Not to knock any other CPAs out there, but we review a lot of tax returns, and sometimes we're left like, did you do this yourself or someone actually prepare this for you? Because it's that bad sometimes. So if you're in real estate and if you have maybe one or two rental properties, you might be fine with a generalist CPA. But if you're serious, you're getting in deeper into the game, you're seriously considering it, I'd have to suggest looking for a CPA that has real estate expertise, because that's how you're going to make sure you're getting you're doing everything by the book and you're taking the deductions. Now, on the flip side of that, you have tax strategist or tax advisor versus tax preparer, right? Most CPA firms out there are tax preparation firms. They're gonna meet with you at the end in January or February, whatever the time frame is. You're gonna give them all your tax documents for the year prior, and then they're gonna go ahead, file their taxes, give it back to you, and say, "Congratulations, you're getting a refund, or you're gonna owe." And that's it. That's literally what they do, and there's certainly value in that. I believe there's value in having that done. However, what a tax strategist is going to do, or a tax advisor, is they're going to look at your situation and say, okay, great. Here's where you are today. They're going to consult with you. Here's where are you today? They're going to collect your information, your tax returns, your portfolio, et cetera, and say, okay, great. This is where you are today. Where are you looking to go? What are your goals? What income streams do you foresee changing? Do you foresee adding in the future? And what's your lifestyle like? All this stuff. And they're going to come up with a plan and say, okay, well, based on everything you have going on here, here's the different strategies that you can use to minimize taxes. Here's here's when they need to be employed. Here's what you need to do to take advantage of them. Like, here's what documents you need to have. Here's the requirements. For example, real estate professional status. Like, you need to meet these requirements. Here's what counts. Here's what doesn't count. Here's all this stuff. Like, they're going to come up with a plan. They're forward looking. They're forward looking at your situation, saying, here's what you need to do going forward to minimize your taxes when it comes time to actually file the tax return. The best way I could explain this is a tax return is like a report card. It's a report card of the activities you did during the year. What a tax strategist is going to do is going to look at what you're doing throughout the year and say, if you make these adjustments to what you're doing, when it comes time to file this report card, you're going to come out with more favorable results than if you didn't. So that's kind of in a nutshell. And the last thing I'll just say on that is, usually when you're working with a tax strategist, if they know real estate, they're going to be able to more effectively help you come up with a tax plan and minimize taxes than if they were just a generalist. They'll miss things. It happens all the time.
Yeah. When do you suggest people employ a tax strategist? Because I think, correct me if I'm wrong, this is your area, but for what I see or people I know, once they start paying a certain amount of tax, like, right, I'm paying six figures in taxes now, I don't like this, I'm going to try to figure out how to not do this. That's when they start reaching out to the more forward looking tax planning. Or is this something that a guy making $50,000 a year should be doing as well? Or where does that start to make sense?
Yeah, I'm going to say probably when you get between like $150,000 to $200,000, if we want to look at an income threshold. And the reason for that is, when you're looking at the U.S. tax system has a progressive tax system. So there's the tax brackets goes from 0 to 37%. If you're in like the 10 or 12 or maybe even the 22% tax bracket, like, there's not that much meat on the bone in terms of tax savings, right? Like, there's only so much someone can save you in taxes, because you're only paying so much in taxes. But once you start getting up there in the upper tax brackets, now all of a sudden every dollar of tax savings you can get is worth substantially more. So I'd say around probably 150 to 250K if we want to look at an income number. Now, we could also look at the activities that what you're doing. If you have a W-2 job and just a few brokerage accounts, maybe you have one investment property, probably don't need tax planning just yet, unless you're planning to really scale. Like, okay, if you're planning to scale, like, okay, once you're starting to accumulate multiple properties, this is a serious thing for you. Like, I'm really going to build out a portfolio. That's when you're probably going to want to speak to somebody, because that's when people can help you set stuff up from the beginning. Stephen Covey, right, the book Seven Habits of Highly Effective People, always says start with the end in mind, right? So if you realize, okay, great, this real estate thing's for me, I see it going somewhere, I could build a lot of wealth, I'm accumulating a large portfolio, then probably after you get like 2 or 3 properties, it's time to start talking to somebody, because they're going to be able to say, okay, great, here's the things you should be doing from the beginning to set yourself up for success in the long term. So I guess just to summarize that, if we're going to look at a pure income standpoint, I'd say 150 to 250K makes sense. Then if you're starting to get serious about real estate and you're going to start scaling your portfolio, that's when it makes sense to start to reach out to somebody.
Gotcha. Give me a rough idea on costs. Like, what is a tax strategist who's going to do this with you throughout the year? What do they charge? Yeah,
so it definitely depends. There's a lot of options out there, or a handful of options out there maybe, but it could cost anywhere between $5,000 to $20,000 depending on who you go with and what options, what type of planning you're looking at. Our firm, we typically work with people within our plans start at $5,000 for a year. So you're going to be able to get an entire tax plan and ongoing support with an advisor for a year for $5,000. Gotcha. So that's kind of where it starts. But there's other groups that go, $20,000, and that's I can't tell you all the stuff that entails, but it can go. Yeah. It could be sizable.
Yeah, I know. Just a personal story. I watched a webinar on a group that I belong to, and they had a tax strategist for sure on there and talking about a lot of the same stuff. And I reached out to him afterwards, like, hey, I think this might be something I'm interested in. And he basically told me, this isn't for you. At where you're at, this does not make sense for you. You need to have X in income, X, paying in taxes, because his fees were, I want to say they were like $20,000 a quarter. Like they were really high. And so if you're going to be paying that to a strategist, you're going to have way more than that is right. Potential savings for that, even to pencil out. Right.
Right.
Yeah. Awesome. I think it's been a great conversation. Anything you think we didn't touch on that is valuable for our listeners, from a tax perspective that we didn't touch on?
I think we covered a good amount. Two or three quick things I'll leave is documentation is key. I know it sounds boring, but having a good bookkeeping system, tracking your receipts, making sure that you just have documentation for the things that you're doing is underrated, but very important to not only deducting taxes, but also being able to just tell the financial performance of your business or your portfolio. That also, I'd say we didn't touch really too much on cost segregation studies. Long story short, cost segregation studies is a tool that can help you. Basically, when you buy a property, it's going to be depreciated over 27 and a half or 39 years if it's commercial property. And cost segregation breaks down the components into shorter class lives, allowing you to increase or accelerate, is a technical term, your depreciation and take larger depreciation deductions earlier on in the life of the property, which could save you a lot of money in taxes. And then bonus depreciation, of course, is the ultimate form of accelerated depreciation, allows you to take 80% in 2023 of the depreciation you should be taking on property with 20 years or less, basically, in the first year. So those are the kind of things to kind of look into, but that's pretty much, we covered a lot. We covered, I would say,
we did. A follow-up question on the cost segregation. In fact, that was on my list. We didn't get to it. But when does it not make sense? So if you have someone who bought a $500,000 single-family home that they're going to rent out, there's got to be a threshold when it makes sense to do a cost segregation and when it's not worth it. Can you speak to that?
Yeah, right. So it depends, but generally speaking, if you're a real estate professional or you're using the short-term rental loophole, it's going to make sense to do a cost segregation study almost any day because you're going to be able to offset your other forms of income. And properties, as a general rule, properties above $500,000 makes sense to do those on in those circumstances. If you're not a real estate professional, you're not using the short-term rental loophole, then the times it would make sense to use a cost segregation study is if you expect to have a large capital gain on a property you're selling, or you expect to have net rental income or passive income from other investments you have, then at that point it would make sense. Otherwise, in those instances, really doesn't make too much sense because you're going to end up having it suspended and carried forward anyway. So, there are unique situations, but as a general rule, I think those are the times it makes sense to do it. Sometimes when it doesn't make sense to do it.
Mm-hmm. Gotcha. Thomas, if our listeners want to reach out or see what you're doing, what's the best way for them to do that?
Yeah, so kind of two ways. We have a website, therealestatecpa.com. If you want to check that out, we have a blog. If you're interested in working with us, you can check that out there. We also have a free Facebook group, Tax Smart Investors. So if you search on Facebook, Tax Smart Investors, you'll be able to find us. It's a great place to ask questions. So if you have questions about this stuff, you can find us there.
Awesome. We'll link to all that in the show notes. It's been a pleasure. I think there's we covered a lot of stuff, and I think you gave a lot of really good tips out, for a newer investor. So I appreciate that.
No problem. It's been a pleasure.
Yeah. Thanks for coming on the show.
Thank you.